So guys, I want to help you learn how to start dividend investing because I've been doing this now for the last handful of years and it's been one of the most life-changing things I've ever done. In hindsight, I wish I would have started decades ago. So in this video, I'm going to give you a step-by-step guide on how to get started with dividend investing as a brand new investor. And by the end, you should have everything you need to get rocking and rolling and start creating some passive income. Now, when it comes to dividend investing, one of the first questions that we need to answer is what the heck even is a dividend? And thankfully, it's pretty straightforward. When you buy shares of a stock on the stock market, you become a shareholder, which means that you're technically a part owner of that company. So when you buy shares of Starbucks or McDonald's or Coca-Cola, you are an owner of those businesses. But you don't get free stuff from them, guys. Trust me, I've tried. Starbucks will not give you a free pound of beans just because you have a few shares in your Charles Schwab account, unfortunately. What you do get, though, as a shareholder is a percentage of the company's profits, which brings us to the dividend. Companies, of course, aim to generate profits from their business operations. Whether they sell coffee, cheeseburgers, or anything else, the whole goal is to turn a profit and generate wealth for the owners of the business. And a dividend is simply a portion of those profits that the company chooses to share with its shareholders. In other words, when a company pays a dividend, it's distributing a slice of its earnings to the people who own its shares, essentially giving you your share of the company's success. A dividend is literally a paycheck that these companies give you just for being a shareholder. And what we're looking at right now are the dividends from my account. You can see all these different payments coming in just because I own shares of these companies. Now, with that said, why should you care? What are the benefits of owning stocks that pay a dividend? Because not every company pays a dividend. One of the main reasons is that the dividend payments are not impacted by the random whims of the stock market. In other words, no matter what the share price is doing, whether it's going up or it's going down, you're still going to receive your dividend payment. Now, if you don't already know, you will soon learn that share prices can fluctuate pretty dramatically. They can go up and down. It's pretty wild sometimes, guys. And a lot of times, these share prices, they can move in either direction as a result of things that don't really have anything to do with the company's actual operational performance. Certain news can come out and a company's share price can either plummet or soar just based on whatever that news is. Dividends, however, are always rooted in the company's actual operations and its ability to generate profits and free cash flow. If a company isn't growing and if it's not profitable in generating free cash flow, then it will not be able to sustainably pay and grow its dividend. So in a way, it kind of forces you to only invest in fundamentally strong companies, which really are the only types of companies you should want to own anyway. And with that in mind, studies have shown that dividend-paying stocks on average have outperformed their non-dividend counterparts over the long run. And that's not to say that it will be like that forever and always, and that's not to say that there's not exceptions to that. But this recent study by Hartford Funds found that companies that consistently pay and grow their dividends have historically outperformed both their non-dividend paying counterparts and the S&P 500 as a whole. As we can see here, if you would have invested $100 in 1973, you would have ended up with way more money today by investing in the dividend growers and the dividend payers than if you would have invested in an equal weighted S&P 500 index. And on top of that, dividend investing allows you to build long-term wealth and create a steady passive income stream without having to sell any shares of your stocks down the road. You see, when you invest in companies that don't pay a dividend, someday down the road, when you're ready to retire and start using some of your investments to pay your bills, you'll have to start selling off the stocks that you just spent the last couple or the last few decades accumulating in order to fund your lifestyle. And there's not necessarily anything wrong with that. I mean, that type of strategy has worked fine for a ton of people for a long time. But personally, I like the idea of not having to liquidate the assets that you just worked so hard to build up, and the income from dividends gives you that option. And because many companies have a tendency to grow their dividends over time, if you don't sell off any of those assets, there's a chance your income will continue to increase over the years as well, which obviously is exactly what you want. And another thing worth noting is that because dividend investing by nature is a buy and hold strategy, it can significantly reduce the stress that comes with feeling like you need to constantly check on the market, and it can prevent you from making frequent trades in and out of stocks, which tends to be a more risky strategy. When you invest for dividends, you'll be more focused on the long-term health and stability of the companies in your portfolio rather than the short-term share price fluctuations that will inevitably happen along the way. This can help you avoid making what are probably poor decisions whenever market downturns do happen, which they certainly will. And during these times, the regular dividend payments can provide you with some sense of security and even excitement as you see those dividends just keep coming in. So with all of that said, what do you need to do to officially get started with dividend investing? Well, step one is you need to choose a brokerage. brokerage. This is kind of like a bank account for buying and selling stocks, and this is where your portfolio will be held. Now, one of the most common questions I get is which brokerage should I use? And there's a lot of great brokerages out there, and I encourage you to look into all of them. But I personally use Charles Schwab for my main account, and then I use M1 Finance for my Roth IRA retirement account. And there are some other great brokerages out there in addition to those worth looking into, like Vanguard, Fidelity, and Robinhood, at least here in the United States. And truth be told, the brokerage that you go with in a lot of ways just comes down to personal preference. There's really no right or wrong brokerage, but if I had to, I would try and steer you in the direction of something more like Charles Schwab or Fidelity as opposed to something like Robinhood. They've just been around a lot longer than something like Robinhood, and I think they're more trustworthy, and their customer service is top notch. It is so easy to get someone on the phone if you need to call Schwab or Fidelity. I actually had to call Schwab earlier today for something super quick, but I was able to get them on the phone in, I would say, less than 90 seconds. I was able to talk to a real person, and that's a really important thing. But with that, now that we've covered the why and the where, now it's time to get down to the what. What should you invest in? And there are a couple different directions you can go with this. You can either invest in individual companies one by one, or you can invest in what are called exchange traded funds, or ETFs, which are basically a big basket of different stocks you can buy all bundled together instead of having to buy each individual stock separately. One example of this is an ETF called SCHD, which is the Schwab US Dividend Equity ETF, which contains over 100 different stocks, many of which are going to be household names that you probably recognize, like Verizon, Home Depot, Coca-Cola, and Pepsi. And SCHD is actually the largest holding in my portfolio. I think it's like the holy grail of dividend ETFs. I put money into it every single week. I actually invest into both that one and a VOO, which is just an S&P 500 ETF. And in general, I think ETFs are the best place to start for anyone who is brand new to investing. ETFs just keep things simple. They allow you to immediately start building a well-diversified portfolio. Okay, you don't have to worry about doing any stock research. It just takes all of the guesswork out of it for you. But moving on from ETFs, I know that some of you will still want to go right into individual companies. You'll want to try your hand at picking stocks, and trust me, I get it. I was the same way when I first started investing. And speaking from experience, if you're going to buy individual stocks, especially, if you're brand new to all of this, I think the best place to start and to narrow down your search is to think about companies that you're already familiar with and ones that you already understand. And for me, these were companies like Starbucks, Procter & Gamble, Coca-Cola, stuff like that. And there are a lot of other great dividend payers out there you'd recognize, like Walmart, McDonald's, Nike, and Visa, just to name a few. So there's a lot of good options. But from here, as you narrow down the list of companies that you're already familiar with, you'll want to start doing whatever research you can into these companies. And this is where it gets tricky as a brand new investor. And this is why I think that ETFs really are the best place to start if you're new to all of this, because when you first start investing, you really don't know what to look for, and you don't know how to determine what makes for a good investment or a bad investment. But when it comes to learning how to do stock research and learning about all of this stuff, I think one of the easiest places to start and one of the easiest places to really sink your teeth into is some of the dividend stats. And there are a few key ones that you should know. With the first one being the dividend yield. This number represents the amount of income you can expect to receive in relation to the company's current share price. And to find the dividend yield, you would take the annual dividend paid per share divided by the company's share price. So for example, if stock XYZ paid $3 in dividends per share and it was currently priced at $100 per share, it would have a 3% dividend yield. And then moving on, the next dividend stat you'll want to learn is the payout ratio. Like we mentioned earlier, a dividend is a share of the company's profits that you get for being a shareholder, and the payout ratio reflects the percentage of those profits the company is distributing to its shareholders. You can calculate this number by taking the annual dividend paid per share divided by the company's earnings per share. For example, stock XYZ, once again, pays $3 per share in dividends, and in this example, they have an earnings per share of $6. So the payout ratio would be 50%, which is not too shabby. A low payout ratio indicates that the dividend isn't taking a huge chunk out of the company's earnings, which is both good for the company and also good for shareholders, because it means that the company is better able to sustain those dividend payments, even if they go through a period where their earnings aren't as high. And it also gives the company more of a runway to grow the dividend, which brings us to the next metric, which is the dividend growth rate. This measure measures the annualized rate at which a company's dividends have grown over a specific period, and we usually look at it over the last 5 years. Now, dividend growth is definitely something that you want because it literally means you're getting a pay raise for doing absolutely nothing besides being a shareholder. We actually see a lot of companies out there with lower payout ratios who are able to grow their dividends at pretty aggressive rates. For example, we can look at Nike here, who historically has had a very low payout ratio. I mean, in the last few years, it's hovered between, 30 and 40%, and on average over the last 5 years, their payout ratio is about 38%. So either way, very low payout ratio. And if we scroll up looking at the dividend per share, we can see that Nike's also been a very solid dividend grower. The 5-year dividend growth rate is 11.3%, and the 10-year is actually even higher at 12%. Furthermore, if we just look at the dividend history chart right here, we can see that Nike's been a very consistent dividend grower. And when it comes to investing in dividend stocks, this is exactly what you want to see. You want to invest in companies who are increasing their dividends over time. But anyway, looking at another example, this company is Snap-on, who, like Nike, has a pretty low payout ratio, coming in between 30 and 40% over the last few years. And the 5-year average is pretty comparable too at 33.5%. And if we scroll up looking at the dividend growth, Snap-on's dividend growth rate is even higher. Over the last 5 years, they've increased their dividend by about 14.3%, so that's a few extra percentage points above Nike. And looking at the chart, this is a work of art, guys. Once again, this is exactly what you want to see. So wrapping all of that up, guys, just in terms of the dividend stats, you want to look for companies who have a history of consistently increasing their dividends over time. And you want to make sure that dividend is sustainable with a payout ratio that's not too out of whack. At the end of the day, it's much easier for a company to continue growing and paying their dividend if the dividend makes up a smaller percentage of the company's earnings, like we saw with Nike, like we saw with Snap-on, which makes the inverse of this true. If the payout ratio is too high, then the dividend growth likely won't be as much because there's not as much room to continue increasing the dividend, and there's also a chance that the dividend won't be sustainable. And another thing that you definitely don't want to do is start looking for stocks with the highest dividend yields possible, because that is a recipe for disaster. Let's look at a company called Orchid Island Capital, ticker symbol ORC, as an example. Now, as we can see here, their dividend yield is extremely high. In the trailing 12 months, it's about 16.5%, which might have you seeing dollar signs, and many investors get drawn in by that high yield. But there is more to the story here, guys. The company, as we can see here, has a negative 5-year dividend growth rate of 21, or I should say minus 21.75%, which means they've actually been reducing their dividend payments over time, which is the opposite of what you want with your investments. And we can clearly see this has been the case just looking at the chart right here. In 2014, they were paying out $10.80 per share in dividends. In the trailing 12 months, this has been cut in basically a tenth, almost a tenth, and it's now $1.32. And there's a name for this particular type of stock, guys. We call them yield traps, and ORC fits the description of a yield trap to a T. Essentially, a yield trap is a stock whose dividend yield is mouth-wateringly high, not unlike what we're seeing here with Orchid Island Capital. But the high yield is actually too good to be true because, as we've established, the dividend payments on the shares that you own is actually going down over time. So you want to avoid these yield traps at all costs. I don't care how high the dividend yield is. This is not a good sign. You want to avoid this. Okay, but now moving on, we've covered a lot of good ground so far, but one of the last things that you might be wondering is how much should you invest? What's a good amount to put into your portfolio? And generally speaking, you should always only invest an amount that you're comfortable with. And if you're just starting out, I'm an advocate for, starting on the lower side. Even if it's just $5 per week or $10 per week, you can always build it up from there. And when I first started investing, that's exactly what I did. I think I first started out by maybe putting $20, $25 per week into my portfolio. And over time, over these last handful of years, I've slowly and consistently increased my contributions to the point where now I'm investing $250 every single week. So once again, if you're just starting out, maybe start on the lower side, get your feet wet, get comfortable with what you're doing, and then you can increase your contributions from there. But anyway, now from here, let's say that you've followed all of these steps so far. You've got your brokerage account all set up and you're investing X dollars per week. You've got some ETFs. Maybe you've got a couple of individual stocks too, none of which are yield traps, by the way. Great job. But what happens next? Now that your portfolio is all set up, what happens from here? Well, you are off to the races, my friend. From here, as you continue to invest, you'll see your portfolio continue to grow over time. And soon, you should see some dividend payments coming in. Most stocks and ETFs pay their dividends on a quarterly basis. Some do monthly, but most of the time it's every 3 months. And depending on when you started investing, it might take a couple weeks, or it might even take a couple months for those first dividend payments to start coming in. But when you finally do get that first dividend, it should automatically be reinvested back into your portfolio portfolio, probably into the stock that paid the dividend, which is totally fine. That's exactly what you want. By continuing this process of investing, collecting dividends, reinvesting those dividends back into your portfolio to go and buy more shares, and then repeating this process over and over again, you're creating what's called the dividend snowball effect, which is incredibly powerful. It's one of the best things in the world, and that's what I'm telling you about in this next video right over here. With each reinvestment back into your portfolio, your dividend snowball just continues to get bigger and bigger and bigger to the point where the growth of your portfolio truly becomes this unstoppable force. So click right over here to learn more about that. It's really freaking cool, and I'll see you in the next one.